what to expect from that big GDP number that will be out this evening. After limping and dragging its feet in the first quarter, the Indian economy seems to have picked up pace in the second quarter. Those are the broad expectations. A Bloomberg survey of economists indicate some recovery in growth from the 2014 lows seen last time. Ira, is India finally getting past that demon GST hurdle?
Fingers crossed, I guess. This is a big number, guys. Every GDP number is big, but this one is critical in all caps. We need to know whether those twin problems have played themselves out, and we need to know what the underlying in the economy is. These are the basic expectation numbers. Bloomberg News survey. I'm putting both gross value added and gross domestic product. The economists prefer to use gross value added, and going by that, the median expectation is 6.2%. The high in the survey is 6.8%. So some people expecting a quicker recovery than others. The low is about 5.7%. Last quarter's number was 5.6%. If you prefer gross domestic product, and that is the more commonly used measure, then the median expectation there is for a number of 6.4 compared to 5.7 last quarter. The high on that is 7.1. The high expectation and the low expectation is 5.9. Those are the survey numbers. Let's talk a little bit about what you want to watch out for. There are a whole bunch of data points that come in. Remember, from a sectoral perspective, you get 8 sectors which make up GDP. Within that, I would choose to focus on these 3. There's a fourth which I'll come to, but these 3 because they had shown the maximum impact of first demon and then potentially GST. So you had, for instance, seen construction come off very sharply in the fourth quarter of last year. It rebounded a little bit but remained weak in the first quarter. Similarly, for financial services, which got impacted by low credit demand, you saw that number come off in Q4 and then further in Q1. Manufacturing will be very important to watch. Manufacturing, remember, could be potentially impacted by GST even in the current quarter. Although the informal sector doesn't get measured, so it may or may not actually come in part of the formal numbers. But you want to watch manufacturing very closely, and of course manufacturing even from a broader economy perspective, very important. I just want to flag off the category of public administration. That was not on the screen, but some are worried about the fact that government may have pulled back on their spending because of their fiscal pressures, so that public administration segment, which typically links into government spending, may be weak this year. If you're looking at it from the expenditure side, the 3 usual components that get looked at: gross fixed capital formation picked up just a touch in the first quarter. Let's see whether you get anything more over there. Private consumption has been flatlining at 6.7% last quarter, so we'll see whether there's any real change there. Government consumption, again, that links into what has been happening to government finances. We know that they have been stressed. We don't know whether that government consumption line will actually continue to come off. So, those are the expenditure side components. There is a bit of a debate on the export side of things. So I'm going to put up what JP Morgan says, but I'll also give you the caveat on that. Sajid Chinna of JP Morgan has been pointing out that the real story behind the slowdown to a large extent has been the contribution of exports to GDP. He has taken a longer period and shown how dramatically the contribution of exports has reduced. And exports, as you know, have been very volatile this year for a whole bunch of reasons. Not everybody accepts this analysis because some economists say that you should look at net exports. And if you look at net exports, then the change has not been that dramatic. Nevertheless, watch out for that export and that net export number, which also comes in as part of the expenditure side data for GDP. All in all, this number will hopefully tell you what the underlying in the economy is, but hopefully keeping in mind that we still know that GST has not played itself out. Now, what part of it gets reflected in the data, what doesn't, the big billion-dollar question.
Now, I want to ask you more data, but I know that you're suffering with the same, sort of lack of sufficient information about the underlying economy. So I'll just put it very quickly on, if we do get that median expectation of 6.2% on the GVA or 6.4 on the GDP, does that set up for, sort of any kind of rate change when the RBI meets in the first week of December?
So I think if you get 6.2 or 6.4, it is consistent with the RBI's expectation that we will see, knee-jerk reaction to both demonetization and GST, but then you'll start to normalize. This pace of normalization would be in keeping with the expectation that even inflation will normalize from here. Apart from food inflation, core inflation will probably stay around that 4.5% mark. So I would not think that a 6.2 or a 6.4 2.4 number would give the RBI any reason to rethink. What could give them a reason to rethink is a low number. So if you get a low number which suggests that the economy has not managed to recover as quickly, that could give the RBI, they have room to cut rates, but that could give the RBI enough confidence to cut rates one last time. If you get a high number, then you can forget about any more rate cuts from here.
Especially in the face of rising commodity prices. So we will get this GDP number at 5 o'clock this evening. Later in the night, just about 4 hours from then, we'll hear from the OPEC meeting.
Yes, absolutely.
So, all of those will be important indicators for where we head from here on in the next month or so.